Hey guys, this is part 2 of my series on the 23 different ways you can use to finance a rental property. If you haven't yet seen part 1, you can find a link to it in the description below and in the YouTube card above. In part 1, I went through all the different traditional ways in which you can finance a rental property as a house hack. In this video, I'll cover 9 different ways you can finance a rental property as a non-owner occupied property. Coming up. If we're just meeting, my name is Vitaly Volpov. I am a practicing attorney, an active real estate investor, and a part owner of a real estate brokerage in upstate New York. I have been successfully investing in cash flow and rental properties since 2011, and I currently have 68 rental units in my real estate portfolio. On this channel, I discuss relevant legal concepts as well as best strategies and tips for real estate investing and personal finance. If you're new to the channel, consider subscribing and hitting the notification bell so that YouTube notifies you of all my future content. Nothing that I say in this video should be construed as legal or financial advice, and the views and opinions that I express are my own alone and don't necessarily reflect those of my law firm or any of my business partners. So a few of the ways to finance non-owner occupied properties that I will be discussing in this video can also be used for owner occupied rental properties. But it's pretty rare to see that given the wide availability of other popular owner occupied financing methods. Also, as I said in part 1 of this series, this is meant as an overview and not a fully exhaustive explanation of each method. If you'd like me to dive deeper into any of these financing methods, please let me know in the comments below and I will make separate videos dedicated to specific methods. So continuing the list from part 1, financing method number 7 is a line of credit. There are a few different types of lines of credit that one could use, but the two of the most common ones you might see are a home equity line of credit and a business line of credit. Both of these methods do require you to have a substantial amount of pre-existing wealth or assets in order to be eligible, and so this is likely not the most readily available option for beginner investors. A line of credit is a type of loan, which is referred to as a revolving loan. Essentially, the bank assesses your creditworthiness and decides up to what limit you can borrow. You don't have to borrow up to your limit immediately and can instead borrow incrementally over time. In this way, lines of credit are similar to using a credit card, though they often have much higher limits and lower interest rates. However, the interest rates are often variable and you will have a set time frame within which you can draw and pay back the amount that you borrowed. Additionally, the bank will often use assets as collateral, which it can foreclose on to recoup its line of credit if you default on it. In the case of a business line of credit, a bank can place a lien against the business's assets, such as its inventory or equipment, as a way to secure the loan. In the case of a home equity line of credit, the bank will place a lien on your home. If you already have a mortgage on your home, the bank will determine whether you have enough equity to borrow on a line of credit, and if you do, it will place a second position lien on the title of your property. Banks will often have a maximum back-end debt-to-income ratio limit, DTI limit, of 40%. If you're not sure what DTI means and how it works, check out part 1 of this series where I go over this concept in more detail. In addition to a maximum DTI, banks will often require a minimum credit score of 620 or higher and will not lend to you if the equity in your home is less than 15%. One other note on this is that the reason I group this method in the non-owner occupied financing group is because most banks will only offer a home equity line of credit on an owner occupied residential property. In other words, you have to be living in an existing property that you own in order for you to obtain a line of credit. So while in theory you could use it to buy another primary residence to move into, you will likely be violating the terms of your home equity line of credit promissory note, which requires you to be living in the property against which the home equity line is being borrowed. So long story short is that you may be able to borrow through a home equity line of credit and use those funds to buy a non-owner occupied rental, but you likely won't be able to use them to buy another house hack. Method number 8 is a very close relative of method number 7, and that is a home equity loan. A home equity loan differs from a line of credit in that it is a loan that you receive in a fixed amount all at the same time. Its interest rate is also often fixed and not variable, and there will be a set monthly payment for a set number of months until the loan is paid off. However, most of the other qualifying criteria that I discussed with home equity lines of credit will apply to a home equity loan as well. So for example, if a lender's lending guidelines allow a borrower to borrow up to 85% 75% of a property's current value, then the maximum debt on the property, which is worth $200,000, will be $170,000. If there's an existing mortgage of $100,000 on that property, then the maximum home equity loan that a borrower can obtain from a lender in this example is $70,000. The borrower can then use these funds to purchase a rental property, assuming that such use is not in violation of the terms of the promissory note. Method number 9 is a cash-out refinance. A cash-out refinance loan is another type of loan which may allow a borrower who owns an existing property to tap into the property's equity in order to use that equity to buy another rental property. Unlike the home equity line of credit or the home equity loan, a cash-out refinance is not limited only to owner-occupied primary residences. In fact, my business partner and I, as well as thousands of other investors across the country, have been using the cash-out refinance method in order to quickly grow our rental portfolios. The idea with a cash-out refinance is that instead of keeping any financing that may exist on the property already and adding a second position lien on the building, you would replace the existing loan, if there is one, with a new loan of a higher amount. And the difference between the existing loan and the new loan would be paid to you directly, which you can then use as you see fit. So an example would be if you owned a primary residence or a rental property which was worth $500,000, but your current loan on it was only $200,000. If a bank was willing to allow you to borrow up to 80% of that property's value, then you would be able to replace the $200,000 existing loan with a $400,000 cash-out refinance loan. $200,000 of the new loan would go to pay off the original loan, and the other $200,000 of the new loan would be paid to you at closing. You can then use that $200,000 to purchase another rental property. If you were able to purchase the new rental property at a discount, or were able to use some of that money to add value to the new rental property you bought, you may be able to repeat the cash-out refinance process with the new property and pull out all or most of the $200,000 back out of it to be used again on another property. So you can see how this method, if done correctly, can supercharge your investing career and get you to that coveted goal of financial freedom quicker. Okay, but what if you don't have an existing business or an existing primary residence or rental property against which you can borrow? Well, you can still simply apply for a conventional mortgage on the rental property you're looking to buy. This would be method number 10. The typical maximum loan-to-value limits that banks have on this type of loan are anywhere between 75% and 85%. This means that typically the minimum amount of cash you must have on hand for a down payment is 15% of the property's purchase price, but can be as high as 25% of the property's purchase price. This is a pretty large difference, so I would definitely encourage you to shop around with many different lenders in your area to see who offers the best terms. Conventional and non-owner-occupied mortgages typically have repayment terms of 15 to 30 years. The bank will look at your DTI, your credit score, as well as the financials of the rental property you're looking to purchase. It will generally be a very similar process to obtaining a conventional loan on a house hack that I discussed in part 1 of this series. However, if the property you're looking to buy has more than 4 apartments in it, or if you're looking to purchase any size property using an entity such as an LLC, you will likely have to obtain a commercial loan and will not be able to use a conventional loan. This is because the secondary mortgage market that I described in part 1 does not allow for conventional loans to be used in those situations. Because the bank will not be able to sell the mortgage to another financial institution on the secondary market, it typically means that the mortgage is more risky for the bank issuing the loan. For this reason, commercial mortgages are more expensive and less advantageous to borrowers as compared to conventional mortgages. For example, many commercial mortgages have higher interest rates, higher origination fees, shorter terms, and balloon payments and/or interest reset requirements after shorter periods of time. However, despite these limitations, commercial mortgages are still a great way to finance or refinance a rental property if you hold it in an LLC for liability protection. I think it is a good idea, regardless of property size, to hold your real estate in LLCs. And if you do so, you will by default be on the commercial lending side of things. If you guys want me to go into more detail on this topic in a future video, please let me know in the comments below. I have been through the commercial lending process many times at this point, and I can share some additional information that I think you will find helpful. Method number 11 deserves a quick mention, and that is a portfolio lender loan for a non-owner occupied rental property. I explained what a portfolio lender is in part 1 of this series, so if you're unsure what that is, make sure to check out that explanation in that video. But basically, this type of loan is very similar to a conventional loan I described earlier. You may be able to finance a rental property in your own name, and this type of lender may have less stringent down payment or other requirements which may allow you to be more creative and outside the box in purchasing a rental property. A portfolio lender lender often also has better commercial loan terms as well. So again, definitely shop around to find the best option for your deal. Method number 12 for financing a rental property is creating a strategic partnership where your business partner contributes the funds or his or her credit and you contribute your real estate knowledge, time, or hustle. The key to this type of arrangement is ensuring that both partners are contributing value and are receiving a share of the ownership that corresponds to the value that they provide. An example would be a situation where you have a well-off but busy relative who wants to get into real estate but simply does not have the time to invest in learning the ropes and managing a rental property. If you do have the time and the energy to learn real estate, find a good deal and manage it, it may be a very good partnership and it may allow you to purchase a rental property even though you cannot finance it on your own. Obviously, you want to be very careful with who you choose as your partner. You want to make sure that you have compatible personalities, complementary skill sets, and similar investing goals. Having the right business partner can mean rapid success, but having the wrong one can also mean miserable failure. Overall, my preference is definitely toward investing with the right partner over trying to go at it alone. Trying to do everything alone was one of my biggest mistakes as a new real estate investor, and it literally cost me $1 million. I talked about this in a video interview that I did last year that I will link up in the description below if you want to check it out. Method number 13 is obtaining a loan from a hard money lender. A hard money lender is an individual or a company that is in the business of lending money to real estate investors. There are thousands of hard money lenders all across the country. Some only lend in their local geographic area, while others have national or even international reach and operate more like banks. Hard money loans differ from traditional bank loans in several important respects. First, although hard money lenders will often vet an individual borrower's credit, their credit criteria are much more lax than those of banks. Unlike banks, hard money lenders are much more interested in vetting the deal that a borrower is looking to buy. Even if your credit sucks, but the deal makes sense, the numbers work, and the lender has a high likelihood of getting back his or her money, the lender will be much more likely to fund your deal than a traditional bank would be under the same circumstances. However, this type of flexibility comes at a cost. Hard money loans often come with interest rates of 12% or higher. Hard money loans are also usually interest only, so the monthly payments you make go entirely toward interest and not to principal. In addition, hard money lenders usually assess borrowers' points at the beginning and sometimes at the end of the loan. 1 point is 1% of the total loan and is either paid by the borrower at the time of loan origination or stacked onto the principal of the loan. Hard money loans are also typically very short in duration, a year or two at most. This means that in order for it to make sense to use a hard money loan as a financing option, you better have a very good idea of what your exit strategy will look like before you get into the deal. In other words, before the hard money loan term is up, you need to be able to either refinance or sell the property so as not to go into foreclosure and lose your whole investment. Just like with all the other options on this list, be sure to do your own research and due diligence before deciding to go with a hard money loan. Method number 14 is my all-time personal favorite method of financing rental properties, and that is private loans. Private loans are similar to hard money loans in that they come not from traditional banks, but typically from individuals who are looking to invest their cash for a good return. The difference between hard money lenders and private lenders is that private lenders are not professional lenders. Private lenders can be friends, relatives, colleagues, or anyone with whom you have a positive relationship who's willing to invest in you and your business. Unlike with hard money loans, with private loans, all of their terms are up for negotiation and agreement. Whereas a hard money lender may not budge from their 16% interest rate with 3 points up front for you as a new investor, your uncle or your best friend's dad, who has some money to invest, may agree to lend it to you for 8%. Whereas a hard money lender will want the term to be no more than 1 year, a private lender with whom you have a personal or business relationship may agree to a 3-year or a 4-year term. The hardest part about private lenders is identifying who they are. Unlike hard money lenders, private lenders don't advertise their services. In fact, they may not even realize that they can be private lenders for your real estate investing business. The way you find out is by talking to anyone and everyone in your circle. And not just asking them for money, but rather telling them everything that you have been doing, like how you're learning new things about real estate investing, what deals you're considering, how those deals can positively impact your future, and how you're looking for a potential financial backer for those deals. The most important key with private lenders is that they need to know, like, and trust you. Unlike hard money lenders or banks, they won't be as concerned with your credit or even with how good the deal is. Rather, they will be investing in you, and you need to make sure that you deliver and over-deliver on all of the promises you make to them. Last and probably least common method of financing a rental property, coming in at number 15, is using crowdfunding to raise money. What I'm referring to is using sites like GoFundMe, Kickstarter, FeathertheNest, and others to raise money in the form of donations. This is not a typical strategy, but maybe one that you can turn to if you have a compelling personal story. For example, if you come from an impoverished background, or you're looking to purchase your first investment property to help an ailing family member, or you have a medical issue yourself that you're trying to overcome, there may be enough people who are impacted by your story who would be willing to donate to your cause. So with that last method, that's going to do it for this part in the series. Stay tuned for part 3, where I will go into some of the more creative and out-of-the-box ways to finance a rental property, whether as a house hack or as a pure investment. Question for you guys: have you used or are you planning to use any of the methods that I described in this video? Let me know in the comments below. I hope that you found this video interesting and informative. If you did, please do me a favor and hit the like button. And if you haven't yet subscribed to my channel, definitely subscribe and hit the notification bell so that you don't miss any of my future videos. Thanks again for watching. Have a great day, and I will see you in the next one. Take care.